So yesterday, one of my YouTube subscribers asked me an interesting question. He asked me, Rohit, when you are buying a stock, do you look at the valuation of the company or do you spend any time doing the valuation of a company? I am making this video to answer that question. First, you have to understand that there is a difference between investing and trading. If I am an investor, I will not look at the charts. My goal as an investor is to find out what is the intrinsic value of the company and then compare that value with the current market capitalization of the company. So let's say I figure out that the intrinsic value of a company is $200 million. Okay. That is what I feel the company is currently worth, $200 million. But when I check the market capitalization of the company, the price multiplied by the outstanding shares of the company, I find that the current market capitalization is only $100 million. So the actual worth of the company is $200 million based on my analysis, but the market is valuing the company at $100 million. So that's a 50% discount. So that is called as the margin of safety. I am getting the company shares at a discount to its worth as per my analysis. I might have read last 10 years worth of annual report of the company. I might have spoken to the customers of the company, the suppliers of the company, the management of the company. And based on my analysis, I came up with a valuation of $200 million. But if I'm getting the company at $100 million in the stock market, that's a bargain. So that is how an investor thinks. So an investor is someone who does not look at the chart. In fact, if a stock is in a decline, a stage 4 decline where the 50-day simple moving average is below the 150-day simple moving average and the 150 days below the 200-day simple moving average, that is called as a stage 4 decline. To me, that would be very exciting because I am an investor, right? As an investor, that would be very exciting to me because I'm getting the stock at a bargain. So, as an investor, I should not be looking at the charts. I should be spending my time valuing the company. Now, as you know, I am not an investor. I am a trader. I am a swing trader and a positional trader. What does a trader do? The focus of the trader is demand and supply. That is why I look at the moving averages. The 50-day moving average should be above the 150-day simple moving average, and the 150-day simple moving average should be above the 200-day simple moving average, and the price should be above all of the moving averages, and all the moving averages should preferably be sloping up. That's a confirmed stage 2 uptrending stock. A stock that is in a confirmed uptrend is under institutional accumulation. So that is called as demand. So as a trader, my focus is not on valuation. My focus is on demand. Okay. Investors spend a lot of time doing fundamental analysis of the company. They don't do technical analysis. They don't do comparative analysis. They might do liquidity analysis. But as a trader, I have to do all kinds of analysis as per the orange trading system. I do liquidity analysis, I do comparative analysis, I do technical analysis, I do fundamental analysis, and I do market analysis. Based on all these five kinds of analysis, I take a decision whether I want to enter the stock or not. And once I decide that I want to enter the stock, I have to classify it as a swing trade or a positional trade. So trading is of two types. Okay, swing trading, positional trading. What is the difference between swing and positional? Well, in positional, we give a lot of weightage to the fundamentals, right? In swing, we don't give much weightage to the fundamentals. Okay, in swing, we are trying to catch the upward momentum in the stock only when the market is in a confirmed uptrend. When the market is under pressure or in a rally attempt or in a confirmed downtrend, I will not take a swing trade. I will come back to the question that my YouTube subscriber asked, but I am giving you some background information before we get into that question. Okay. So that's the difference between swing and positional. In swing, I might hold on to the stock as long as it remains above the 21-day exponential moving average. In positional, I would like to hold on to the stock as long as it remains above the 50-day simple moving average. So I am a swing trader and a positional trader. For those of you who are busy working at a 9 to 5 job, who are busy working in a corporate regular job, for those of you who do not have time to sit in front of the computer screen while the alert goes off and the stock is breaking out of the base, for you, I would not recommend swing trading, because in swing, by default, we are getting into stocks that may or may not be fundamentally strong, because we don't give weightage to fundamentals in swing trading. So if you cannot be in front of the screen to micromanage the trade, why not only do positional stock trading? That less headache, stress free, in a relaxed manner, you can take positional trades, because in a positional trade, if the stock is have experiencing good EPS growth, if the stock is in its growth phase, if the business behind the stock is in a growth phase, usually that growth phase will last 18 to 24 months while the stock is creating five bases, right? So for those of you who are very busy, who cannot micromanage the trade, I would recommend positional stock trading. Okay. And for those of you who are busy, you can't read annual reports of the company, obviously you can't invest. So you have to come to trading. Within trading, go for positional, forget about swing. But if you're someone like me who has the time to manage the trade, you should be taking swing and positional trades. But for swing, you have to wait for a confirmed uptrend. Coming back to the question that one of my YouTube subscribers asked, he was asking, Rohit, do you check valuations of the company? Now, I do not check valuations of the company because I am not an investor. I am not comparing one company with another company, or I am not comparing one company with another company in the same industry. I am looking for a demand and supply. If a stock is in a confirmed stage to uptrend, forming a base, I will not hesitate to buy the stock even if the PE ratio is something like 64. Okay, 64, anything above 40 PE ratio is an expensive stock as per value investors theory, right? If you talk to any value investor, 64 PE ratio is a very high PE ratio. Okay. But we as traders, we do not hesitate buying the stock even if it is expensive, because our understanding is there is a reason why the stock is expensive. Why? Because it is experiencing extraordinary growth, not only compared to other stocks in the same industry, but compared to the overall stock market, number of stocks available in the stock market. This stock could be showing extraordinary EPS growth, maybe triple digit. Remember, Zomato recently was showing 400% EPS growth. Dixon was recently showing 261% EPS growth. That is extraordinary growth in profits, right? So these kinds of companies should actually trade at very high PE ratios, because they are showing that kind of a growth. The PE ratio is directly proportional to the growth of the company. The more the growth of the company, the more the investors or institutions are willing to pay up for the stock, because they want to capture that growth, right? If the PE ratio of a company is small or below average, usually there is a reason. Maybe the growth rate is declining, maybe the company is incurring losses, maybe investors expect that the company in the future is going to experience losses, right? By the way, if a company is experiencing a loss, it will not have a PE ratio, because the E in the PE ratio is negative. Okay. So maybe the profits are declining. Maybe the growth rate is declining. That is why the company is getting a lower PE ratio. People are not paying up for the stock. Now, if you read Mark Minervini's book, he says that if you buy a stock at any PE ratio, I remember him talking about Yahoo in the 90s. It was trading at PE ratios, like absurd PE ratio, like 300 or 400 PE ratio or something. He still bought the stock even at that multiple. And then the PE ratio went all the way from 400 to 1600 for Yahoo in the 90s. Okay. So it's on a standalone basis. If you look at the P ratio, it might look overvalued. But the stock has a potential to get even more overvalued in the future as long as the growth rate in the company is maintained. Okay, which was what probably happened with Yahoo. That is why the P ratio went from something like 300 to 1500, right? Crazy valuations. So what Mark Minervini was saying in his book is that, let's say I buy a stock in the early stage, let's say the P ratio is 64. Technically I'm buying a overvalued stock, but after it gets into late stage bases like base 4, base 5, I would be interested in checking the P ratio there because I want to compare what's the P ratio here compared to the P ratio when the P ratio when the uptrend, the confirmed stage 2 uptrend actually started. So at the start of the uptrend, what was the P ratio? Towards the end of the uptrend, in the late stages, what's the P ratio? He would compare that. So the P ratio goes from 64 to 128. That's a double uh, P ratio, right? So investors are willing to pay twice as much for the earnings of the company now, even at that late stage, because of the high growth being experienced in the company. So whenever the P ratio becomes 2x or 3x during this confirmed uptrend, that's usually a technical sell sign. That is usually the time when you should be reducing your position size, taking money off the table, because now the stock has become so extended. It has not only got into late stage, but the valuations have gone probably crazy. He also says in the book that the absolute number does not matter. What matters is how much has the PE expanded. In this case, the PE has expanded by 100%. Sometimes it expands by 200, 300%. Okay. So if the PE ratio goes up 2x, 3x during that 18 to 24-month period from base 1 to base 5, if the PE ratio is going up 2x, 3x, the company is going from being overvalued to being even more overvalued, right? So those are times to start booking your gains because the stock is at late stage already. It is sitting on high risk. He says that the standalone PE ratio does not matter. This number could be 400. From 400 it could go to 800. Okay, because there is a reason. If a stock is valued at that high PE multiple, there is usually a reason for it. People want the stock, people want to buy the stock, people want ownership in the company. They anticipate explosive earnings growth in the future. So as a trader, we are looking at demand and supply. We are looking at where is the money going. Okay, and we are aligning ourselves with the market. We are not fundamental investors where, I would look at a stock that is falling, a stock that is losing its PE ratio, a stock that is losing its shine in spite of being fundamentally very strong. Okay, I don't want to be involved in that situation. I don't want to buy a stock that is falling. I want to buy a stock that is rising. Okay, so this could be checked. So, say for example, you buy a stock at base 3, or say for example, you buy a stock at base 4, it goes up 25%. The first thing you should do is to check what's the P ratio here and then go back to base number 1. Even though you bought the stock at base 4, go back to base number 1 and check what was the P ratio. If you see the P ratio going up 2x, 3x, that is a sign to start selling. You may not want to sell all your shares, but you might want to sell majority of your shares, maybe 75% of your shares, to take the money off the table, because nothing remains overvalued for an infinite period of time. Okay, no matter how great a company, uh, it will become overvalued after some time, and it will begin to uh, fall. It will begin to collapse. Okay, that's the nature of the stock market. That's what I wanted to convey. So the simplest valuation metric is a PE ratio. And as a trader, I am not interested in the PE ratio. I am interested in the expansion of the PE ratio, just as what Mark Minervini has taught me. By the way, full credit to Mark Minervini for explaining to me this system. This is not my original idea. I just read the book and it made sense to me. Okay, that is why I am explaining to you what I have understood from what Mark Minervini has taught me. Thank you so much.